Hi, this is Randy Finney with the right side of the chart, and today is Wednesday, March 9th, 2016. Let's take a look at the markets, where they're at, where I think they're headed here. I'll start out with the big picture. I often struggle knowing that there's always a continual inflow of new people coming into the site that haven't really heard what I've said in the past, what I'm thinking, and I always try to impress upon those points, but also not beat a dead horse. There's a balance there with those in the who have been following the site, hearing the same things over and over. So just to quickly look at the long-term charts here, and I wanted to spend most of my time on the intraday charts, but the bigger picture, which I've harped on for many months now, is that more than likely we're in a new bear market, and you can reference the videos on the YouTube page or older posts on the site, but this is the Wilshire 5000, which is the most representative, and this is really where the last bull market ended up here when we peaked, and the Wilshire again being the most representative of all indices out there, really. You can see that one's already dropped 18%. So you want to call it a bear market, you can. You want to wait for that official 20% definition that's most commonly used. Either way, it's one heck of a correction, but I believe more so than that. Again, the case was made, and it's not only a small fraction of that case is here on this chart, but you can look at things like this 40-week moving average, the red line, which is a 200-day moving average. It does a really good job of defining major trends. And just like the previous bear market, or bull markets, I should say, bull and bears, we usually come back and test that line from below. Here's the S&P 500. There was a top back in '08. We break down, and almost always you don't come up and make a perfect test. Usually the market will punch through there for a couple weeks. But you tend to fall back down, and so far that's what's happened here. And this is the S&P 500. So let's get down now. Again, this goes into formulating my overall big picture, and let's just jump all the way down to the 60-minute charts. That's what I've been posting lately, and this is more relevant to us swing traders. I think that bigger picture is every bit as relevant to the swing traders, I should say, because it helps formulate my overall bias. Do I trust bearish patterns at this point, or do I trust bullish patterns? In other words, when the primary trend is down, bullish chart patterns are more likely to fail, and those that do break out and play out are more likely to fall shy of their expected targets. So whereas the bearish patterns on the flip side are more likely to play out and more likely to play out to their measured targets, and often then some. So bear market is just a bull market flipped upside down, really, when you're looking at the charts. The only difference is, or the main difference is, stocks tend to fall a lot faster than they rise. So you have to be more nimble when trading a bear market, and that works both ways. The bull market rallies are powerful, so you can make a lot of money trading both sides, and even if you don't short stocks, you can make a lot of money in a bear market trading those counter trend rallies. You just have to be quick, and you can't stay to the party too late, because when those rallies end, you don't want to be the last one standing without a chair. So this is the S&P 500. I've talked on the targets that I had. This is the SPY, the tracking ETF. The target range, the key resistance was about 1990 to 2000 on the S&P 500, which is right about, it's where we failed here. This line's comparable to about the 1990 level on the S&P 500. And, I put these up recently. These are just very clean, bearish rising wedge patterns. The lines that you see here, the dotted lines, if you look over to the left, you see that 100% number. That's the highs in the S&P 500 that it put in, the highs back in December, and that was the big move down. We really had a double bottom in the S&P 500. So this lower yellow line here is the bottom of a Fibonacci retracement level. And so what we did at this point, this rally after the second bottom, which was also a divergent low, that double bottom, I stated that was bullish. That led us up, and we made a 61.8% retracement, which is still well within the range of a typical retracement in a larger rally, and again, a larger trend, assuming this is a new bear market. So this is as objective an area to short. We had the major overhead resistance that I've talked about in some recent videos, both in the QQQ. Still a little room to go on the Qs, but the SPY is really getting up there. And as I said, those aren't hard lines. They're areas, and you have to look at all the indices together. Sometimes you'll see everybody's watching the SPY or the S&P 500, but yet maybe the QQQ, as I did point out, had a little more upside to go to hit its comparable levels. And I'm talking about those support shelves from the late 2015 trading ranges that broke down in the beginning of the year, right after trading started on, I think it was January 4th. So that's that. Those are the levels. We've pushed back up. Yeah, I know this is a big W pattern, looks bullish, and I know a lot of people out there clamoring for new highs, and anything is possible. You know, as I said, what I look at in trading is the risk to reward. Sure, new highs are possible, and I mentioned before in other videos where my levels would be to stop out, but what I do is, I'm taking that overall longer term bearish outlook I just touched on the weekly charts, and I'm saying I'm not going to hold out for any more. This is where last week I started adding back short exposure, and once these wedges broke yesterday, that's where I've taken it up pretty aggressively now. I've continued to close out longs in the last couple weeks and start scaling into shorts, and as of last week, I posted I was net short, and I'm even more short as of now. And these are just clean patterns. That's all. You have this bullish rising wedge pattern defined by this uptrend line and this uptrend line. These lines down here on the MACD, the RSI, this custom histogram that I have, the trend indicator, they're all showing divergence, which confirms that a bearish rising wedge. If you see a rising wedge and you don't have the divergence, can it play out? Yes, but it's not as likely. These divergences confirm that an impending trend change is likely. These are momentum and price oscillators, and just as I should say, these bullish divergent lows, you take this little line, not the big one there, the little line here that had that divergent low, and I was wrong, not wrong, I'm sorry, long, actually right, off those lows. And remember, how I trade, I don't, I will use these breakouts to add or confirmation, but this is where I was low. This is where I was low because I look at these patterns. This was a descending price channel. You had this divergent low on the 60-minute chart. That's my cue to go long, even if the primary downtrend is down. That's where I started reducing my short exposure here as these divergences were forming, and when we had that sell-off, that's where I was long. Just like up here, this is where I started to get short, and this is my confirmation now that everything looks good. And I'll point out something. S&P in the trading room, S&P does a great job. He's one of the most valuable contributors, trade ideas, market commentaries, and he made a comment today that it just doesn't feel bearish. He made a couple of comments about the market, and not to knock you at all, S&P. You're again one of the most valuable contributors in the trading room. But when I see those comments, I'm looking right now as I'm doing this video. The S&P 500 is up, or the SPY is up, 0.4%. So a pretty good day. So my point is, of course, it doesn't feel bearish. This is when I want to short. I wanted to short here when it was even less bearish up top. That's when I started shorting and scaling in, and I added here. So I'm glad to see this today. This gives me an opportunity to add. Now, if all this bearish price action becomes undone, then yes, I'll be wrong. I'll have to stop out, or I'll have to start considering my stops will be up here. But I didn't want today to be down, 200-300 points in the Dow, thereby denying me more objective entries. I wanted to scale in. I like this price action. Just because we haven't fallen off a cliff after breaking these wedges doesn't mean that the charts are not clearly bearish. Right now they're bearish, and the fact that the markets are holding up today really doesn't mean much. What'll happen is things will start feeling bearishness once the market drops. But I don't want to wait for another 5-10% drop in the market to then become fully or aggressively short. So that's that. That's the technical picture. Again, you can see these were times to get bullish, and this is a time to get bearish. The charts are there, both short term, long term, and we'll just run through the rest of the major diversified indices. I mentioned recently that, especially at the tail end of this rally, which is indicative of a bear market rally, at least in the early stages of a bear market, not late stage bear market rally. But the early stage, you see that everybody, the confidence started becoming, at this point, when we took out those previous reaction highs here in the broad markets, you had undoubtedly a lot of short covering, a lot of bullish sentiment started ramping up. Everybody went from bearish to, oh no, the world's coming to an end, to, oh gosh, we just took those out. We're going to see new highs now. And so what happened is the risk on trade came back on. Those were the shippers, a lot of the beaten down energy stocks. It's still, many of those names still have a good chance of, filing for bankruptcy protection any day now, despite this, recent move up in oil. And I'm sure before all is said and done, some will. But yet there was what I refer to as a dash for trash. That's the risk on trade. And now, as the risk on, when I say risk on, the small caps, those are more aggressive stocks. So that's also a risk on trade. You see the breakdown, and this is where I think we'll have more bang for our buck. And so far we have. We've seen yesterday was a pretty big down day on the IWM compared to, let's say, the S&P 500 or even the NASDAQ, which held up for a while. But I pointed out some underlying breadth issues there with only a few big names keeping the NASDAQ 100 up. So there's the charts. They're pretty clear. Bullish divergence down here. You see this low in the IWM. That's when everybody was bearish. That's when bearishness was at its, hit the highest levels that we've had in many years. And that's exactly when I was bullish because of you see the rising wedge here. You had this descending price channel breakout, a rising wedge that put in, not only did that wedge have, you see down here, this line here, and all the lines below, bullish divergence, you had even larger bullish divergence on that new low down here from this point to this point. And now, again, I'm just looking and flipping the charts upside down. We have a bearish rising wedge, divergence on the MACD, and equal peaks. As long as this MACD doesn't make a higher high, that's still divergence. You could call it negative divergence or flat line divergence. You have prices rising while the MACD has failed to make a higher high. Along with prices. I don't see it on the RSI. You did make a slightly higher high there. But one other important development on this chart, and I posted this out the other day, is this trend indicator. The trend indicator, I use this 1333 pair often on my 60-minute charts. It's just a custom histogram of the 13 and 33 EMA. So instead of having the lines up here where you see them and it's hard to distinguish the crosses, the histogram shows you the differential between the two, or the distance between the two. So when they cross, that's when it goes from red to green. So these are bearish. This is a bearish cross with the 13 moving below the 33. And I've always said when you have these trend indicators, at least the way I use them, when you have these shallow moves like this is a whipsaw area. That's when the market's trending sideways, and I don't pay them much attention. But when you have these clean, what I like to call mountains or hills, where these extended periods like this, and down in red territory, then you cross up. That's time to take notice. That's time to get out. Now, that didn't play out for a whole lot. The market traded sideways, but either way, it told you if you were still short that you might not want to be short anymore. And again, that taken in context with the bullish divergences, the break of the downtrend line, everything else, that was a no-brainer at the very least to get out of your shorts if you were still short, even if you didn't want to go long. And again, you can see the trend flipped here. We're bearish from this point all the way to this point. And now look at this. This is the point I'm trying to impress here. We've had this extended green run with the 13 above the 33 EMA. And although it hasn't crossed yet, you can see that cross is all but pending. Rarely do you come down, tap that level, and move back up. Usually, you can just look at the chart here, especially after an extended run. Usually when you make that cross, you might get one little blip afterwards, but it's usually good for a new trend. So this looks to me, the bearish rising wedge, the breakdown. I put the bear flag that I covered yesterday on the 10-minute chart, IWM. Right here, we had the pulsive move down, the bear flag, another pulsive move out of it. And sure, they've foiled that action so far. You would expect this bear flag to break down to at least, I was looking for this target zone, and I still am. This isn't, the IWM's almost flat. So did they foil that flag? I mean, it played out a good percentage of the move. Let's see here. Really I had the flagpole drawn from that peak up there before we gapped down. And as I said, that would have been right there Actually, I had my measured target a little high, to be honest with you, because I'm looking now. You're supposed to place the flagpole at the top of the flag, so that's where that should have been right there, just to clarify. But either way, we played out, good over half the way there, maybe 2/3 of the way down. And we're just consolidating today, so I don't try not to take anything of this. It's not a win for the Bulls just because we didn't continue to lower. It's not a win for the Bears, although the last few days is the very short-term trend, for what I like to call the near-term trend for the last few days has been down. The market's making a series of, especially the risk on, which is now risk off trade, short the IWM. Nobody wants to be in the small caps. They are making a series of lower lows and lower highs, and that's a downtrend, just as this was an uptrend, a series of higher highs and higher lows. So, and if you look here on the 10-minute chart, I'll put a line right there. I like to use these volume at price histograms. That's the red and green bars here. There's a lot of trading going on here. That's what that represents. Those are volume at certain price levels. And these thin zones like this are very comparable to gaps. So you can see this trend line here, or the horizontal line I just added, defines these reaction lows and these reaction lows from yesterday. So my expectation is that when or if, and I do think we will, I'll make that clear, we break below this level, we're going to go down here pretty quickly. This is sideways consolidation. I don't see a break of this level and meandering on down to this level. I see if and when that goes, more than likely, we'll come down and we'll come down somewhere here to this level. But I'll tell you, you got to look at the big picture too. The bigger picture are those 60-minute charts I just talked about. This is only a 10-minute chart. It also, below this support shelf, it's very thin. You see the next big bar on the volume at price histogram comes in at this level here. In fact, in the bottom of it, that's actually what I'd be targeting, and I think I did mention that in the post yesterday on that 10-minute chart. You see this gap back here, which was tested again, 3 nice reactions and a gap right there. This, my friends, this is the target that I'm looking at right now before I even consider reducing any short exposure unless I'm stopped out. So I'm about as short as I want to be right now, and again, I've already mentioned the other videos, my longer term plan, because I put these on as swing trade shorts with the potential that we may go down for weeks or months now. But I'll watch the charts. I'll keep an eye on the intraday charts. I've also mentioned in the last couple videos that I can see the possibility that we trade around sideways for a couple weeks, even a couple months here, and frustrate the bulls and bears alike. And that's why I'm one of the reasons that I'm partial to shorting the 3-time long ETFs, because if I get stuck in a sideways trading range for some period of time, at least that decays the market, especially as the market goes up, down, and really decays the price of those 3-time leverage ETFs. That will work in my favor. So, you can draw this out here. Again, this is a lot of my focus right now is on the IWM, and there's a nice little bearish pennant, if you will, following that flag. So let's see a break of that, and that might bring us down. Again, this is only a minor target area right now because that bear flag's already been foiled, and I don't see a whole lot below it to down here. So this wouldn't surprise me. And if you want to quantify that, if you're trading, let's say something like TZA, I'm looking at IWM, that's a 3.5% move, so multiply that by 3, and that's what you'd expect in something like TZA if it does happen. Okay, here's QQQ. I can't remember, did I talk on SPY or Qs earlier on the 60? Either way, I just wanted to point out that on these trend indicators, you do see we have crossed bearish here. So on the Qs, down here, the 13.3 trend indicator on that 60-minute chart, and that's what I'm focusing a lot on right now, the 60-minute time frame, has gone to bearish. And let's see if I already talked on that in the SPY. SPY, SPY, here we go. And I mean, we're right there, 0.19. So we're looking at a pending cross. We had that breakdown. We've struggled to hold that comparable. Let's look at it on the SPX. We're at 1984, so we punched above the 1990 level. Even the 2000 level, as I mentioned, we probably would overshoot it because all the eyes were on. Most people, I think, were watching 2000, anywhere from 1990 to 2000. and we took it out by a little bit. We had that wedge overthrow, again, one of my favorite patterns in trading, when we have a bearish rising wedge and you have an overshoot right before the point where wedges normally break down, and then prices come back down in. From there, I usually see a very impulsive move lower. So one other thing to look at here as far as trends go, again, this is why I do videos, there's so much to cover on a chart, are these crosses above and below the MACD. If you look at where the MACD is right now, and this applies to everything I've just covered, the IWM, the QQQs. When the MACD is above, it works similar to this 1333 trend indicator. I like to use the signal line, that's the white line here, the 9 EMA, wait for a cross there. That's the ladder of the two to cross because it follows the 1226 pair. So when you cross over, or in other words, when prices are trending below, you have a bearish trend. Okay, let's draw that out here. So, back at this point, you had the 9 EMA trading below, and as you can see from above, the trend was down. We had a couple whipsaws there. You can see the whipsaws down here, but here's a clear trend. This is when, and remember, this is taken in conjunction with everything else. As I said, even back in 2015, until this support level, this would be our next major sell signal. I identified before it happened, and as it happened, and right after it happened. We had a nice back test in the Qs. So that was our sell signal. That was easily confirmed because the MACD, the trend indicators have all gone bearish down here. So you had this long extended period, as you can see, where the 9 EMA was below, and that was really about this much. So it caught the bulk of that move down. Things chopped around for a little bit, but it was showing you at this point. Oops, I should go back up here. You can see bullish trend indicator, and what did prices do? They drifted higher over that point. So these are what keep you in the trade, especially for most of you out there. If my primary style is swing trading. I'll day trade when the opportunities are there, but my primary style is swing trading. And these are the swings I'm looking for. This is the point where I day trade. I'll get in this chop when the market's grinding, take those quick in and out opportunities. Try not to go home heavy overnight because the near-term direction's indiscernible, or at least I'm not very confident of it. But you get these divergent lows, especially on the 60-minute chart, and that's where I like to position for swing trades. And now it's simple. I'm looking at impending trend indicators going bearish. A couple already have, as I just pointed out on the Qs. Divergent highs confirming that. Again, you can look at the MACD right here. We're not there yet. The reading is 0.9, but that's the MACD line. The 9 EMA will follow. So any more downside, it almost appears as if the S&P 500 is flagging just below the breakdown of that wedge. It really is. I could draw that if I zoomed in. And so those are your sell signals, folks. The 1333 EMA going to red or below zero. The MACD crossing below, especially after this extended run here. And this is what I'm looking at for what will likely be at least a multi-week swing trade to the downside. And if the charts convince me otherwise, maybe we break down, maybe the markets want to make a back test of those wedges. A back test is when prices come back up here. If I extended that line and come up a little bit higher, it's possible. I just don't see it right now. And if it does, we'll take it from there. Alrighty, I think that's all I wanted to cover for right now. So again, I went over the S&P, the QQQs, but my favorite of the three that I just talked on would be the Qs, and as well as the IWM, because they are the higher beta indices. They tend to rise more when the market's doing well and fall more when it's not doing well, especially right now, especially following that what I call dash for trash, and not to mention the IWM. I should have pointed out, if I haven't already, that it hit a very nice resistance zone. You can see it here on the 60-minute chart. Go back, 2-hour chart. We have nice resistance all up in here. Prices traded up above that level for a long time going back. This is now a 4-hour chart, so you can see that that's a formidable resistance zone and one heck of a rip. Look how overbought. This is a 4-hour time frame, and look how overbought the RSI came. And that goes all the way back till almost a 1-year chart history there. And daily time frame, you can see as well. RSI had overbought. And if we are in a new bear market, I can tell you it is very rare to see RSI, a broad market, a broad index, reach overbought levels. In other words, 70 or more on the RSI. If you get that in a bear market, it is a golden gift. Just like in a bull market, when you get RSI levels of 30 or below, you want to load the boat. So that's, again, it's not a buy alone or a standalone buy indicator or sell indicator, these oversold and overbought readings. But here's the last one. We had a near 70 tag. And that was actually about when IWM peaked back then. But just something to note there. Okay, this has been Randy Finney with the right side of the chart. Hope you enjoyed it.